Audit Planning and Fieldwork Part 1. What is auditing? The audit work needs to be properly planned in order to conduct an audit effectively and efficiently. Firstly, pre-plan, client acceptance. It must accept a new appointment or stick with the existing client. After accepting, the auditor should make sure the familiarity threat to be competent to perform audit and to keep their objectivity and integrity. Next, in the engagement letter must have the objective of the audit of financial statements, scope of the audit financial statements, degree of auditor's assurance and form of audit report. The main purposes of having this letter are to protect from legal liability and to document contractual rights. However, an auditor can issue a new engagement letter. This happens when a client misunderstands the objective and the scope of the audit or any significant change in nature or size of the client's business. After issuing of the engagement letter, there must be fraud and errors towards the financial statement itself, which possibility that some material misstatement in the accounts. If there is any fraud in the accounts itself, it may be an act by those charged with governance, employees. As for the error, it refer the mistakes in the financial statements that may arise out of omission of an amount or a disclosure. Errors are caused unintentionally. For example, arithmetical, data entry, programming and scenario mistakes or misinterpretation of facts. After finding out the fraud or errors in the financial statements, there are auditors' objectives to be found when auditing the financial statements follow. Firstly, management's assertions. It's about the claims made by members of management regarding certain aspects of a business. Secondly, the transactions-related audit objectives, TRAO, an auditor's primary responsibility, which are occurrence completeness, accuracy, summarization, classification, timing. Other than TRAO, there is also the balance-related audit objectives, BRAO, an auditor follow from management assertions and provide a framework which, existence, competence, accuracy, cutoff. Knowledge of client's business and industry. To find out the knowledge of client's business and industry, it's obtain client's background information. The purposes are, it provides an important input towards audit planning and it will help the auditor to identify events and transactions that may be of audit significance and provides him with a better basis. After obtaining the client's business background, an auditor must assess or need to have thorough understanding of the industry. For example, the critical issues facing the industry, significant business risk and structure and profitability of the industry. After that, auditor should be the preliminary analytical procedures. It also applied at 3 stages. First is planning stage by determine nature, extent and timing. Second, testing stage is to identify significant matters, and lastly, completion stage, which has a final review for material misstatement or reach conclusion about true and fair. Last but not least, materiality. What is materiality? Materiality is the criteria used by the auditor to distinguish between unimportant and important matters. The concept of materiality depends on the size of the item or error judged in the particular circumstances of its omission or misstatement. Thus, materiality also provides a threshold or cut-off point rather than being a primary qualitative characteristic which information must have if it is to be useful. Next is types of materiality. First is quantitative. It's based on the size of the misstatements in terms of monetary value, which generally material that require rectification. Thus, the cumulative effect of the misstatements is about an auditor must also recognize if the immaterial misstatements are grouped. Second is qualitative. It based on the nature of misstatement, which mean an auditor cannot quantify the materiality decision in all cases. For example, misappropriation of fund and loss reported as profit. Other than that, the users a financial statement. An auditor shall ensure that notes to the account contain informative disclosures about the company's performance,